Despite guys like us trying to find crazy explanations, stocks really go up for just one reason, folks: more buyers than sellers. And there have been a lot more buyers than sellers lately. Bank of America data showing inflows into stocks and stock ETFs topped $6.6 billion this week. That's compared to a $1.6 billion in outflows from bonds. Joining us, Bob Dahl, Chief Equity Strategist at Nuveen Asset Management, and Brian Hamilton, CEO of SageWorks. Bob, you kind of heard our talk, rant, whatever you want to call it at the top. Everybody loves stocks. Housing's hot. I'm starting to get a little bit nervous that things are almost too euphoric. What's your take?
I'm not sure they're euphoric yet, Brian. Obviously, we've traded past the upper end of the range that we established before, but there's still a lot of doubt out there, a lot of naysayers. I think the market will continue to climb the wall of worry, and the fact that stocks are cheaper than a lot of other things, and a lot of other things have ceased to be attractive. Cash ceased to be attractive some time ago, and now bonds are struggling, and stocks have been the game in town. There's more money coming in, as you just pointed out.
So is the stock market then, Bob, fundamentally attractive based on earnings, valuations, price to book, price to sales, or is it simply the best of any other option?
It's certainly some of both, but I think it's a both and not both or. That is to say, stocks, half of them have a yield higher than a 10-year treasury. That's almost unheard of. Most of the time, it's only a handful of stocks. That alone tells you, relative to something else, stocks are pretty interesting. Dividends are going up at a double-digit rate. Last I checked, the earnings reports are okay, not great, nothing to write home about, but they're making a positive move in the right direction. You put all that together, I think the market grinds higher. Look, we're not going to go up another 18% as we have since the first of the year, in my opinion, but I think the market ends higher than where it is today, worth putting a couple of bucks in.
Brian Hamilton, your firm SageWorks digs in and does data mining perhaps better than any firm in the world, so we love your insight. You're generally an optimistic guy, but you're starting to get a little nervous too as well. Tell us why.
Yeah, here's why. We are 48 months into an expansion. There's no doubt about it. Rick is totally right. But remember, the average time that happens is about 55 to 58 months. We're going on the back side of that, and our unemployment rate is still too high.
Okay, so just because, though, we're 48 months in and the average is 58 months, that doesn't necessarily mean, Brian, that we have to contract. I mean, that's the average, right? I mean, you could skew the mean, skew the average, no matter what. What are the odds that we go up or down?
Yeah, it's hard to say, but look, we look at data over the past 80 years. We're 4 years into this very strong expansion. We've been talking about it, for the last 4 years. And unemployment is still too high. There's still too many people on the fence in terms of hiring. So we can never predict how long it's going to continue going and when a recession might kick in. But we're getting on the back end on, the 17th or 18th green, basically.
It's interesting, Bob, because Josh Brown, he's on the show a lot. He had a really interesting blog post last night, and sort of been our theme on this show for about 2 years. That despite all these things that are going on, China fears, European worries, still high, jobs still under, historical growth, GDP, we have powered through it. Is it because of the resiliency of the American consumer, or is it really because we've fundamentally misunderestimated and maybe misestimated the positive impact of a housing recovery?
Some of all of the above, as usual, and I might add a couple of more other things to it. Look, there's nothing like my house price going down that causes me to worry, and nothing like my house price going up to make me spend a couple more bucks. And I think that's certainly been part of the driver. Look, it was part of the Fed's objective in all the things they have done to create some more confidence. We've gotten some on the consumer side, need some more. We need to convert that to business confidence so we get more capital expenditures. I think with a lot of excess capacity, as Brian's pointed out, in labor, but also lots of other places, we have further to go in this business cycle.
Very quickly, Brian, if you had to guess, 12 months from today, will the unemployment rate be higher or lower?
I think it will be lower. But remember, a year ago, I was saying it would be about 6% right now. So that shows you my predictive ability.
I told people you were an optimistic fellow.
It's true. But look, here's what's happening. We are growing. Private companies are growing about 10% a year. It's unbelievable. Average net margins about 6 to 7%. Very high. Good cash flow. Why are they on that fence? And as we keep going down that line, I still get worried about that unemployment rate, because if we're at 7 or 6.5% when things are good, what happens when we turn bad? Remember, we are a cyclical economy. We always have been, so we can't plan on continued growth forever, basically.
Brian Hamilton of SageWorks, Bob Dahl of Nuveen. Gentlemen, both, and we'll see you later. Take care. Have a great weekend, guys.
Thanks.